Welcome to Money on Tap, your personal finance headquarters. Money on Tap is where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. My name is Seth Krussman.
And I'm Ben Brayshaw.
Good morning.
Good morning. How are you doing?
Or good afternoon.
Yes.
However you're jumping into the show today, wherever you're finding us, we're glad you're here. And one of the fun things that we get an opportunity to do is connect with you. And you can do that by calling us at 855-226-8551 or email us at info@yourmoneyontap.com. And that is also the website where we have loads of information for you, past episodes and current episodes that you can listen to of Money on Tap. It's at www. Do I even have to do that anymore? Does everybody know? It's like it's just yourmoneyontap.com.
I think people get it now. Yeah, yourmoneyontap.com.
All right. It's a pretty sophisticated audience today. We know you are. In light of that, you can also find us at Facebook /3D Investing, or my favorite, folks, is the Twitter spot. You can tweet with me at BFG_LLC.
I like what we've got coming ahead of us here, Seth. I'm kind of seeing a little bit in the future, and I'm kind of excited to share it.
Oh, that gives me chills down my spine. The clairvoyance of Benjamin Brayshaw.
How many times do people walk in the office and be like, "So what's going to happen? What do you?"
Oh, every day.
It's just like, they're not asking, what do you think? It's like, what's going to happen? I mean, what should I do? How do I? So we've been lying to people for years, telling them we don't know exactly what the market's going to do, but today we do.
That's true. That's what we're. I don't know how we've gotten away with the misinformation out there for so long, but we're going to get there, and we're actually going to get on topic eventually here. And the topic for today is the Dow Jones Industrial Average. It's going to hit 30, folks.
It's going to hit 30.
Yeah.
It's going to hit 30.
We did a Dow show a while ago, and this is like 2017 when it hit 20. And that was a lot of fun, but that was a little after the fact. And we're going to bring home to you why this Dow Jones Industrial Average I'm like, I didn't say that. We're going to just talk about the Dow Jones, folks. We're going to have some fun in this show, and we're going to get a little bit of history. We're going to get a touch on the ifs, thans around the Dow and some important dates. And what does that mean for you?
Well, I'm excited. I'm excited about this. I mean, the Dow's over 27,000. Things are looking great, and there's all these people. There's the negatives. There's the positives. There's the, everyone's got an opinion on what's happening next, and there's so many moving pieces in the economic puzzle here, and a lot of people need some direction. A lot of people are seeing a lot of trend changing, a lot of things happening, a lot of indicators for concern, a lot of indicators for potential major growth, and people are trying to hedge themselves. And we're seeing, the market's reporting less and less investments inside, the private money flying in. So that's kind of interesting, and I think people really need to have some understanding.
All right, but before we get too far down that road, it is time for Money in the News.
I love the lighthearted stuff I get to find here, and you Oregonians are quite a bunch of fun people, and I know you saw this article, but you got some rabid bats, Seth, in Southern Oregon, and I was noticing that this might be a real issue for you guys. So I hope I didn't bother you with this article after the goat article last time. The goat yoga. You guys got some crazy stuff going on over there, but
we got it all.
Yeah. But this is like a public health warning over bats. I mean, do you guys not know not to touch bats who are flopping on the ground, looking foaming at the mouth?
I have touched many a bat flopping on the ground, and survived to be here today and tell you about it.
He protected his dog, and he got bit. Sorry, no one's read the article, but go ahead, Seth. You tell the story. We'll give you the Oregonian bias.
Yeah. Well, here's the gist, folks. Is that when you see the bat flopping around on the ground, wear gloves, or call a professional. If you're not that daring, or if you're not able to find gloves, just call a professional to take care of this. You do not have to subject yourself to rabies. I remember as a kid, a friend of ours brought a bat to our house. Yeah, I don't remember where it came from, but she was like one of these people that would like gather up animals that were lost. And she had a possum, like a baby possum one time, and it was just the cutest stuff. And so this is a baby bat that she found. And we all, got to hold the baby bat. And today I don't even know if that would.
See, that's the problem right there. That kind of thinking.
This is what we grew up with.
This article has nothing to do with finance. After the GOAT article, I was like, there's a bad article for you. So
bless you. You are so my person. Thank you.
So, hey, but this is to our crystal ball. We got a couple articles here, Seth, and this is interesting. So, Senator Elizabeth Warren from the great state of Massachusetts, right around the corner from me,
love it,
is saying buyer beware in the stock market, crash is coming. What do you think?
That's a lie. You're sneaky. You're so sneaky with that. That's not at all what she's saying. She's saying we are so far away from a crash that, and matter of fact, that she doesn't even think that. I mean, she's saying we are nowhere near a crisis. That happened over 10 years ago. Her response to that is what? There's no crisis. And even if a recession is anywhere near, is not even a question that she really
she's not even taking it yet. It's not even a conversation.
No.
Exactly.
Yeah.
I think it's interesting because she, for as much as the Democratic side is concerned about the market or trying to create woes about the market on some levels, she's actually stepping in and talking about some of the things that are going well in our economy. Like, for instance, consumer debt is dropped to all-time lows compared to income. And I mean, it's phenomenal. And remember when we did that podcast a long time ago about how millennials have spun the coin to become more savers than Gen X, Gen Y, whatever all the gens are. But the millennials are actually big into saving. Not big into investing, but big into saving. Remember that?
I do. And good job, people. Good job minimizing the debt and taking advantage that the interest rates are low. So people are paying off their credit cards and getting rid of those. Now, student loans, that's a totally different story. But I have a funny or an interesting story about this the other day when you talk about the millennial. We were having a conversation, and he was kind of going through some marriage counseling stuff that we were talking about. And the situation that came up was he doesn't even consider himself a saver. He's just not a spender at all. Like, never spends money.
That's interesting.
So how do we get two people on this? Well, we need to spend money because we're a family now and we have to do all these things. But there's usually a gas and a brake in a relationship. And anyways, he was totally the brakes. But creating a budget around that is great. So if this is what's going on right now, people are budgeting, people are spending less. Fantastic. Does that necessarily reflect on ultimately what's going to be happening in the economy? It's one perspective.
Yeah, I mean, I think that's really interesting how people how they perceive their actions as not being a saver, but they're just not a spender. Like, I think that's really very interesting. But in this article, they keep going on how like there's all these really very strong, very financially studious kind of things going on, and one of the things was that credit card delinquencies, they're up a little bit since 2015, but prior to that, they're like at all-time lows for the previous like roughly 20 years, 22 years. So that was really very interesting. I mean, people are addressing debt, and I think, and I'm wondering too, with the fear of debt, I wonder how much the fear of our national debt has driven a lot of this. Like, everyone's in debt and credit cards and so forth. I mean, it's just interesting because the debt conversation, everyone wants to get out of debt. And that's great. I love that story. There's the movement.
Dave Ramsey.
He's all about
Yeah.
it. I mean, there's a nice movement in that area. People are taking debt seriously for probably one of the first times we've seen in our country at a grand scale in probably 25, 30 years or more.
Yeah. Well, they've seen the catastrophe that can happen when it isn't it isn't addressed in our personal or corporate finance, both equally. And coming back to that Dave Ramsey, I was talking with an advisor this last week, and he has taught the class multiple times. I've taken the Dave Ramsey course, and I think it's fantastic. What we really both agree, and he'll talk about this in teaching the course, is that it's not about getting out of debt. I mean, that's definitely one aspect of it, and it's not about this and that and this and that. What it ultimately boils down to is your relationship with finances and changing the way that you relate with finances. And that kind of goes back to the guy that I was talking about a minute ago. He's not a saver. He just doesn't spend money. It's the same thing, right? But it's a different relationship. Does that make sense?
Yeah, I think sometimes you have a dependency relationship and sometimes you have a power relationship, and some people are dependent on spending money and some people, don't. And a lot of it has to do with upbringing, one side or another, someone doing without or, having too much of, or I've seen people who said, I grew up and we didn't have any food. So, so-and-so was spending money on something, I think that's, there's learning sides of each curve on that. And it's just interesting to see how whatever has happened in the millennial cycle has really pushed people to become more savers. And that strengthens our economy greatly.
Yeah. So next up is the other side of the coin, folks. What I see coming across our desk, it's a stronger, there's a stronger case out there these days for the bears, I think, than there was. And, but the Fed can't stop the market meltdown, warns the forecaster who called the 2008 housing bust. And James Stack basically talking about right now where the Fed is at, what they're trying to do, and the levers that they're trying to pull, really not going to be able to stop what's ultimately going to be happening in the marketplace. And or re-stimulate the economic growth. So what do you do? What do you do in this case?
Well, I think this is where the three-dimensional side of what we talk about is really, really relevant, Seth. We're dealing with so many different moving parts. Like, for instance, the repatriation tax that Trump put in place that, led to over $1 trillion of assets coming back to America, and, Apple bringing $253, I think, billion back to America. I mean, that's a quarter of their company. So Apple, the first $1 trillion company in the world, brought a quarter of its company back in cash to America. A lot of these companies are buying back their stock, which is producing a lot of substance, as I would call it, underneath their stock value. I mean, it's a buy and hold world, right? So the longer people buy and hold, the stronger a stock becomes, and the more a company buys back their stock. I mean, that really does create some strength behind the stock value because they're retiring shares essentially. So I think that's really interesting. They obviously wouldn't buy back your stock if you didn't think it was cheap. If you're going to overpay for your stock. So a lot of companies who brought money back to the United States did that. I think that's one thing there's substance behind the market. That an argument a number of years ago was that, there was no real new money coming to America. China made that claim, and now we have $1 trillion has come. So there's some substance there. I think the trade deal eventually will come through with China. The worst case scenario is it'll be the same trade deal we had before, right? But we're trying to push higher, and people are concerned about how that's going to impact our spending every day. And well, I mean, when you really break it down, that tariff argument, if that just gets higher, that's more taxes going into our global economy. I mean, our national economy, from a standpoint to deal with some of our budget and so forth. Now, that'll probably all be spent because I'm a pessimist in that area. But those are important things. And I think once that trade deal sets, that's going to bring more money to the United States. I mean, I think, and I believe it to be that it's going to cost Americans less than the amount of money China has to pay in addition to. And I think there's going to be a net win there, though I do think it's going to affect all our pockets. So there's a lot of moving pieces that I think really will spin positive for us. But that doesn't change some of the stuff that's going on where we're seeing a lot of movement the small caps are not performing as well. We're seeing a slowdown in that in the Russell 2000. We're seeing a lot of things that are happening inside the marketplace that are saying, hey, these are some indicators. I think this is why the crystal ball we're gonna offer in the show is gonna is going to be very, very interesting. And I say that obviously sarcastically, but there's a lot of things to consider than some of the hype and what's going on.
Yeah, like what you said there, as far as the transportation being softness in the manufacturing sector, weakness in small caps. These are all indicators that could point in that direction. But we've seen some of these pull back in prior year and then take off again. Last 6 months, there was best bull run or best 6 month period in 20 years in the market. But there's also the other side where that's investor sentiment starts getting frothy emotional appeal when everybody stops, thinking about what are the underlying components to the economy and how that's going to play out. And they just keep going into, ultimately, the market, which could be like 6 stocks right now, pretty much representing the bulk of the market in tech. So a cool article, Stack getting out there, putting it out there, saying, he did predict, he was one of the predictors of the 2008 market collapse. And his statement is here that next 2 or 3 years is what he's kind of seeing as far as that next opportunity after the market turns around and presents a kind of a savings on the buy.
Yeah, and I'm concerned. I'm really concerned about the tech sector. I really have a lot of fear for the tech sector. In general, I think we're at a 20-year swing here. 20 years ago, we were dealing with a tech bubble that burst horrifically for a lot of people who are riding it high, and we're in that same thing. But with some of the millennials and some of the people our age and whatnot that haven't really, we were coming out of college 20 some odd years ago. Like, we were not heavily invested in our 401ks or anything like that, but people who are now getting close to retirement, and they have been potentially enjoying that S&P run, that index run with a tech. And if you're listening to this, this is buyer beware, because the FANG stocks, Facebook, Apple, Amazon, Netflix, Google, and then if you want to throw Microsoft in there, we talked about this. This is huge. But back in 2000, look at this. We talked about Microsoft, Cisco, Intel, IBM, AOL, Time Warner, Sun Microsystems. Which one of those is the dog of the, it's great to see Microsoft there twice, but do you see any of the other companies?
Not at all.
Yeah. So, this is a
blip.
Yeah. So, do you have a 1 out of 6 chance of choosing the right one? Or are you going to take a massive hit? And I think last December when Apple dropped 35% or something like that, in 1 month, that's horrific. I love Apple. I have an iPhone. I have Apple equipment in my house. I have iPads and whatnot. But I think we need to understand our history and learn from it and watch out for this tech issue. And those are some things that, people are really kind of riding this like euphoria of a wave.
Little crystal ball action going on there with you, Ben. I'm feeling it.
There you go.
That's going to do it for us on Money in the News. We are bringing to you a show, Dow 30. We're going to lay it out there for you in just a little bit. Don't go anywhere. We'll be right back. You're listening to Money on Tap.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call three-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap, your personal finance headquarters. This is where you get an opportunity to pick up that phone. Not if you're driving. We understand that. But just pick up the phone. You can give us a call at 855-226-8551. And we'd love to connect with you. You can also reach us at info@yourmoneyontap.com. Website is yourmoneyontap.com. We are talking about Dow 30K. Right now, we're not there, but we're doing a little bit of shout out. We're calling it. We've got our crystal ball here with us, which is, I don't know. That's Ben. You were talking about people coming in and asking you, what's going to happen? And I've got door number 1, door number 2, door number 3. That's kind of what I feel like sometimes.
Yeah, I mean, I think I'm a short range optimist right now. I don't think we're looking at a 10-year bull run again. But when we do investing, we really try to hedge the downside pretty heavily in a lot of the ways we work and things we do. But I do think there's some euphoria. I do think we're going to see Dow 30, but again, we don't really know, right? So that's unfortunately the crystal ball we don't have. But there's a lot of pieces in play where I think even if we're having some trending kind of out of the market or hesitation and so forth, we have enough tailspin here to kind of, I think, push us over. But does the Dow really matter? I think that's the question.
Good question. Good question. I think I actually I saw you levitating a little bit there as you were looking into that crystal ball. That's a new trick for you. How did you do that?
Oh gosh, you're funny.
So the Dow Industrial Average. Now this is, I love history. I think this is probably, for me, it's some of the most fun that I get a chance to do is to kind of dig in and find out, why do we have, the things that we look at, what are they? Why? What's the history of some of what's taken place in, something that's a bellwether out there, the Dow Jones Industrial Average?
Yeah, I mean, it's like people put a lot of weight on the Dow because it's just such an old mechanism that we use to measure the market. It's not necessarily like any other mechanism out there that we use. And there's a lot of credence given to it by the general public, but not really by us advisors. I mean, the Dow's moving, okay, whatever. But that's not the numbers I'm looking at the screen. Are you, Seth?
Yeah, no. I feel like I'm supposed to say no to that, Ben, but I love looking at the Dow. It's so fascinating.
It makes everyone happy when it's up. They're like, oh, the Dow is up. And they're like, oh, what happened to my account? And it's like, not moving. Yeah. The Dow can move and completely be totally erroneous to anything that you're looking at or seeing in your retirement plan or whatever. And then yet it could be in correlation, but trust me, it's random that it is.
Right. So where does it come from? This Dow Jones Industrial Average.
Yeah, well, I mean, it's over 100 years old. It was designed by Charles Dow with Edward Jones, a statistician, and the Dow Jones Industrial Average was created after they created the Dow Jones Transportation Average. So it's the second oldest, and it was created in 1896, and it was really meant to measure kind of the industry performance as a whole. I mean, just trying to grab kind of a general understanding of the market. It started with
they did that by incorporating 12 stocks. Everything ran in the world at that point in time off of 12 stocks, people.
Right. And the thing is like today the Dow is only 30 stocks. It's not even, I mean, it's 30 stocks. I mean, we talk about the S&P 500, that's 500 stocks. And which is a much better averaging scenario of understanding our market than easily by far with the Dow. So Seth, I want to test you because I didn't do this earlier, but and I was wondering. So name 5 stocks in the Dow.
Oh, shoot. You are going to test me.
Oh, I am. I'm testing you hard.
All right. Give me a second here. What are we looking for?
Ding, ding, ding.
Yeah. Oh, well, it's not GE. I can tell you that.
GE's
anymore.
gone. GE's ripped out. That's right.
Gone. Oh, man. Oh, what is the Travelers? Is Travelers still in there?
Travelers is in there.
Okay. Travelers is in there.
That's one.
Okay. Cat's not in there anymore.
Yep. No,
they?
Cat's in there. Cat's still there.
Oh, Cat. Okay.
Cat's still there.
All right, Cat. City isn't in there anymore. I'm like going to name the ones that are not in there.
Yeah, City's gone.
Yeah. And who else?
Okay, so you got Coke, you got Exxon. I'm just going to read them off. Goldman, Home Depot, IBM, Intel, Johnson & Johnson, JP Morgan, McDonald's, Merck, Microsoft, Nike, Pfizer, Procter & Gamble, Travelers, United Health, United Technologies, Verizon, Visa, Walmart, Walgreens, Disney. I didn't even start at the top. 3M, American Express, Apple, Boeing. Wow.
Yeah.
And I mean, obviously it's in there, but Chevron. I mean, there's, it's like companies you don't think about it because it's all large cap. And all we do is talk about large cap, and you're like, oh, which one is getting in, which one getting out? I mean, GE was in there for 110 years, and they just pulled them out because they just crushed. And these things are changing constantly.
Yeah.
Yeah. So I think what's interesting about the Dow, and what a lot of people don't understand, is it's not an equally weighted indice. So basically, it doesn't matter how big the company is. Apple versus Boeing versus Coke or IBM. It doesn't matter how big they are. They just take the stock price and it's basically divided by itself, essentially. So if you're a $100 stock or $20 stock, you get equal weighting. It's just those stocks. But what they do is they work backwards on all the stock splits, and it's basically get back to what I would kind of call like a core value of that stock price and breaking it out. So, and then it's just divided. Now, unlike a lot of other indices, everything is usually equally weighted, and they try to weight things out so you can see a comparison. Like if one company's twice as big as the other, they'll get twice as much credence as the other one. And so that creates a better, I think, indice of understanding the market, which is why we could really almost care less about the Dow when people talk to us. And oh, hey, the Dow. I have clients call me, oh, hey, the Dow was up today. I was like, oh, it was? Oh, great. But you tend to see a lot of movement that, if one's up, the other one's up. Like if the S&P's up, the Dow's up, vice versa. They're usually moving somewhat in correlation of positive and negative movements, but not all the time.
Like an example of how that Dow relationship works or doesn't, depending on what you like or dislike here. So a 30% gain in 309 billion JP Morgan was only good enough for 136 points. While the 101 billion, like a third the size, Goldman Sachs contributed 415 points with a 36% increase in the Goldman Sachs, relatively the same, or 6% off on that as far as the gain.
So a third of the gain in the asset, so a third less in the gain in the asset, but the Dow grew 250% more comparatively.
Right.
Wow.
That's not a proportional relationship especially considering that's 309 billion versus 101 billion. So, yeah.
You'd think they'd at least be at least equal, right? I mean, you say, hey, this one grew 309 million, this one grew 100 million. Like, well, the 300 million should be at least the same amount of movement or more, but it's exactly opposite.
It is. It's totally opposite. They should swap 415 and for JP Morgan and
folks, you're hearing it first. I think we need to retire the Dow.
But there are some things there, like the companies that you're talking about, those 30 that are in the Dow, 30 of the most successful companies in the U.S.
Yeah.
And they're global companies as well, but those are 30. Those are 30 companies that just crush it.
Yeah, and I think that's why we're just looking at them. It's really just saying, hey, what are these companies doing? I mean, unfortunately, it's not equally weighted. But, there's been some track record to the Dow that has been valuable to people. And, you can't just go out and buy the Dow. Like buying the weighting of this, you can try to buy an index that matches it, I guess. But, it's really, they're all over the place. There's no, you're not buying tech, you're not buying, in specific industry or healthcare. It's just a very peculiar mechanism for managing assets. And there may be some level of genius to it because we've obviously given it 100 and, whatever years of attention. So that's important, I guess, in some level. But it's just funny how much people focus on the Dow. Our clients look at that all the time, and it just doesn't have as much weight with us because it's not an equally weighted index. I think that's important to understand. It's a price weighted index. So
very good. Yeah. So let's take a look at some of the history. What are some of the markings or what we experience today? Where have we traveled through with the Dow? The first one that really shows up is in October of 1929, the great crash, Black Monday. Dow plunged 23%, which is huge. But it's interesting to me, take a look at that as well. At this time, unless you went out and you bought, what was it, 12 stocks at that time? I'd have to take a look. Unless you went out and bought 12 stocks, these 12 stocks, it didn't really matter because now you can buy kind of the index through different vehicles. ETFs or mutual funds, whatever you got in there. You can certainly go buy replicas of the index, but you couldn't at that time unless you were just trying to create it on your own.
Well, neither of those things existed back then.
Right.
So
exactly.
So
take that.
Exactly. You could try to buy it and do it. It's one of those things. It's so hard to calculate. The Dow divisor was probably started off at 12. Okay. But because of all the working backwards and all the movement of it and so forth, the Dow divisor is like 0.14 or whatever. And it's like goes off. It looks like, pi.
Hey, Ben.
Yeah.
Ben, I'm just going to have to tell you, you were wrong.
Oh, I'm wrong. Sorry.
It was 16.67.
You're right.
So wrong.
Yeah, you're right. It was, but it was a whole number. That's the whole point. It's like,
right.
It has had so many changes that the Dow divisor is now down to a version of like the version of pi. But it's below 3.14.
Pretty
it's
darn
like,
close.
Yeah. It's like 0.14.
0.146. It goes on and on and on and on after that.
And I haven't memorized it. So, but Seth, but you make
I could tell you two stocks out of the Dow.
That's horrible.
I'll tell you that
That's
number.
horrible. So, so what you're talking about with key dates, this is interesting. So the Dow's available for 34 years. Okay. The crash in 29 happens, and then it takes 25 years from there for it to get back up to surpass the pre-crash peak. 25 years later, just to get back and cover it. That's huge. So now you're looking at 60 some odd years out there, and we're just barely cusping it, and we're not even at Dow 1000 yet.
No.
Dow 1000 doesn't even come till 1972. Okay?
Yeah, another 20 years.
Yeah, it's like, in the New York Times, the quote on this was the New York Times likened it to breaking of the 4-minute mile in a run. That's crazy.
Yeah.
It was such a huge deal. And no one was ever fathoming, Dow 30,000 coming. Dow 30,000. So then...
I'd like to take a look at that. I'm curious. I can't remember who it was. There's been a couple folks out there that have thrown some pretty big numbers out there on the Dow. But go ahead.
Yeah, no. So what I just was going to say, but from 1972 to double the 1,000 to go to 2,000, it takes 15 years to 1987. So 1987, we see Dow 2000. See, a lot of people who don't have the history of the Dow think we've just kind of been moving up at this very generally steady pace. But what? It's like we didn't cross Dow 15,000 until, what was it, 2013.
It was 13, yeah.
So, we're looking at Dow.
We're post.
Yeah.
Yeah, we are post Great Recession and hitting 15,000. And it's not something that really people look back and talk about at this moment. But it's really recent.
Yeah, I mean, we're talking 6 years ago. I mean, the Dow.
Oh my gosh.
the bar chart on the Dow is like it looks like the letter U on the right hand side. I mean, it's like, and it's a slow mechanism, and all of a sudden we hit 2000, the 2000s, and the Dow. I mean, from
Ben has raised 4 children and gotten them through college in that amount of time, folks.
Yeah. See, I mean, we didn't cross. I mean, think about it. So the Dow was at in 1999, the Dow was crossed 11,000, and in 20 years we've gone from 11,000. It took 113 years to get to 11,000, and it's taken 20 years to get to over 27,000. It's really hard to evaluate the Dow as something to monetize inside your portfolio. And I think that's one of the things that's really complicated, because the returns and so forth don't necessarily mimic what you are potentially doing or not doing. Yeah. That's just one of those things. I mean, that's why I think I like the S&P 500 so much, is that you have 11 sectors. There's sector rotation. There's investments that you can do that way. You can focus on healthcare. You can focus on industrials. You can look at equal weighted. The Dow is such a skewed.
I feel so bad for liking the Dow.
I know, but it's
now that you say it that way, I'm just like, what was I thinking?
Well, it's exciting. I mean, I turn on the TV. I'm a jerk. I'm talking about it, and I'm thinking to myself. I turn on CNBC, and it's like, boom, there's the Dow. Oh, the Dow's up today. Oh, yay! Yeah. I mean, it's the same thing. It doesn't matter who you are. But then I'm like, I don't really care. I'm waiting for the thing to scroll through to the, to the NASDAQ or the S&P or whatever, industry we're looking for. So it's just kind of funny, but we all get this kind of happy feeling when we see the green Dow, and they play it up so well. Oh, the Dow is down today. The Dow's down. So anyways, it's just an interesting conversation around how to understand marking your investments to the market properly.
Yeah. So right now, where we sit, we're gosh, what are we? If we were, I think we're 11% off of 30,000, roughly, in terms of the Dow.
Yeah, 11, 12. Yeah.
And which coming back full circle on, how soon are we going to get there? Yeah, I mean, 11% really isn't that big of a move. I mean, maybe. I mean, it's nice. I'm not going to say it's not great, but I mean, it might be a year. But if you were to take a look back, it might be, a couple of months. But something interesting about the market is that markets can also be moved by this investor sentiment that's happening. And potential factor there is that people just want the Dow to hit 30. So they keep throwing it at it,
Yeah,
like, let's just...
Yeah, I
mean,
push it. If Boeing gets a bump and things happen, I mean, those are the types of things. It's like the Dow's still growing, and yet Boeing is like in the news constantly, right?
Yeah.
I mean, I think Southwest is pulling out of Newark, New Jersey. I think I read an article on that because of the Boeing event. I mean, there's lawsuits left and right. So what's going to happen to Boeing, and how might that hold back the Dow? Right. Those are things that you want to kind of be aware of. I think understanding the Dow is helpful because it really gives people a better perspective on knowing how to articulate that against their portfolio. But I also think there's a little bit inside the Dow where, if we do get, what happens if China trade deal happens? And what if it goes through? I mean, the relief I think our market will feel, I think, is going to be huge. I think if we get that trade deal, I think the Fed's going to look at things a little differently. We're going to have more cash coming to America. There's just going to be a lot more activity, I think, happening. And I think a lot of those concerns and woes will be pushed aside. And I think we do see Dow 30,000 before the end of the year, if that's the case.
Yeah.
Do we see it in a couple of years? It might take that. It could.
That's an interesting idea. What do you see in a couple years? Do you see Dow? I mean, we went from 20 to 30. It seems like overnight. It was just 2017 that we hit that 20,000, and we were talking about the Dow 20 on Money on Tap.
Right. No, I know we were.
Dow show.
Yeah, I mean, we called that. So,
I still haven't figured out what in the world's in the Dow, and it's taken me that was 2 years ago.
But the thing about this that's really very funny though is that we are continuing to say what's going to happen in the market. And you know what? The political climate we have right now, I used to, when I first got into the business, someone used to tell me, don't ever talk about politics or religion. Don't ever talk about politics and religion. And it's like,
but those are our two favorite things to
our country is designed to talk about politics and religion.
That's why you call me at like 3 a.m. when you're like getting up and East Coast. You're like, Seth, have you seen what's going on?
Yeah. Well, I mean, when you think about it, talking about politics and religion, these are real things. I mean, these are real things that are going to affect our economy. And if you can't, even whether you agree or disagree with anything I think or whatever, we will all agree that politics and religion will drive events in the market. If we have a military attack on Iran tomorrow, we are going to have an event in our market. If South Korea decides to launch a missile that's live into another country, we are going to have a market event. If Trump gets elected or doesn't get reelected, we are going to have a market event around that. Those are facts. And it doesn't matter which side of the aisle you stand on either of those issues. We all know that we have to address those things. And when people come to us, what do they come to us for? To manage and mitigate those issues.
I was going to say they come to us to, ask us what's behind door number 3. You're listening to Money on Tap. We are talking about the Dow Jones Industrial Average. Before you come back, I'm going to go do a little bit of research here and figure out where Ben got that snazzy list of 30 stocks that are actually in the Dow. We're going to be right back talking about the Dow. You're listening to Money on Tap.
Hi, my name is Seth Krussman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap, your personal finance headquarters. You can reach us at 855-226-8551 or info@yourmoneyontap.com. If you're just joining us, we've been talking about the Dow. Ben has been saving my bacon today because
I'm going to come clean. I like to say I know all 30 stocks of the Dow by heart, but I really don't. And if you had asked me which 5 were there, I would have probably named 5 that were pulled out.
All right, we got to cut that out because really what happened was Ben grabbed the crystal ball from me and started looking into it and being able to read what's going to happen or what has even happened or what's currently happening in the Dow. But we're going to bring it back because we've said, hey, this Dow thing. We've talked about the history. We've talked about kind of why the Dow isn't really something that we look at as any kind of a indicator around the marketplace, just because of the size of it. The stocks that are in it are, can be great, but it's only 30. There's only 30 stocks in comparison to like the S&P 500 or the NASDAQ or some of these other indexes out there. But we're going to bring it back, I think, here to what you can pull out of the Dow and potentially how you can read into the Dow.
Yeah, I really like this, Seth. I mean, one of the things that we don't look at the Dow a lot, but what we can say is, yeah, it's the 30 largest companies usually in America, and how they add and subtract people, companies out of it is up to the Dow Jones. But that being said, there's a lot of components to the Dow Jones that you can look at outside of it, technical analysis that you can kind of pull from that. what is going on in the Dow right now. Like there's like a few stocks that are kind of people are concerned about in the Dow and what they could do in a negative environment, what's kind of going on with them. And those stocks specifically are Caterpillar, Boeing, Exxon, and J&J, Johnson & Johnson. They alone, if they crush, if they get pulled out of the Dow or whatever, they account for about 18% of the gain. We could see a hit of 18% on that scenario. That's a concerning factor. And Boeing has some real issues. I mean, they got some real lawsuits going on. I mean, people are losing business big time because of Boeing. These are concerns that could take our $30,000 Dow prediction right off the table very, very quickly.
Don't say that. I would hate to eat my words in a year where the Dow's at 25 and I told you it was going to be 30.
Well, it's going to be 30 someday.
Oh, that's a relief. So 16 of the 30 names in the Dow right now is what we were talking about here with are in some kind of a bearish technical setup. Besides the Exxon, Boeing, Johnson & Johnson. And what does that mean? I mean, technical indicators are some of those trading indicators that are used by tactical traders or trying to understand the underlying holdings in the Dow. And one of them is called a death cross. And that's basically these three, the Dow of members of Exxon and Boeing and Johnson & Johnson's are close to this death cross territory. 16 of the 30 names in the Dow are in some kind of a bearish technical setup at this point. And then, that's just the Dow. That doesn't even really get into the S&P 500. There's definitely a fair amount.
Yes,
I think it's about 15%.
Yeah, 15%. Yeah, I mean and I think that's where we're really kind of the market has a lot of like, what's going on? What are we doing here? And how is that going to impact me? And should I take? And honestly, I think the hesitancy is fair. I think the hesitancy, they the amount of money going into the market, new money and things like that, there's definitely a sideline presence. And that's something that, people watch. They watch trends. They watch the number of trades that are made below what they call even lots. Like if you're a small investor and you're buying $200 shares of Apple and you buy 85 shares because you've just got enough money to get that many shares in, that's not an even lot. And there's technical analysis that's managing and watching those lot purchases to see how much is potentially like the average Joe investor and what's institutional. And they're watching that. There's a mood, there's a swing, and there's a lot of technical analysis and strategy around how investing is occurring. And that's really interesting because with the sidelining of a lot of money, it shows that America is a little hesitant to say, am I in it? Am I buying at the top right now? Yeah. I just want to see something, right?
Yeah, Johnson & Johnson historically has been one of those places, kind of a bit of a flight to safety. I mean, this is a blue chip stock, but if the economy's really taken a turn, Johnson & Johnson's one of those that a lot of people will go and move their money over into because it just doesn't move as quickly. It's a little less risky of a stock out there just because of the size and the weight. But I mean, even comparison to Boeing, which is about 9.39%. I don't know if it's at that current level now in the Dow. It's not even as big. But the other indicator there might be your ExxonMobil, right?
Right.
With which is historically, I mean, gosh, I'm trying to think back. When was Exxon the largest company in the world? I think that's 2000. Yeah. That's around that 2007-ish time, I think, and I can't remember when they got taken over.
Yeah, right, exactly. And but there's all this technical stuff that's happening with these companies, and one of the things that we use, and we use heavily with a lot of the managers we work with, is that 200-day moving average work that we do in the backside of one of the technical indicators, and that's a pretty common technical indicator is looking at 200 days of moving average of an asset or an indice or a sector or something along those lines, and watching that money move or that asset move in value, and it starts trending to a negative. It starts dipping that average. And then they look at things like 50-day moving averages, and there's like kind of these guardrails, as we call it, on both sides of those things. And they're looking for trends that are going to break through. They're looking for the 50-day moving average pushing through a guardrail or the 50-day moving average pushing through that 200-day moving average. And when those things happen, those are concerning event factor items that, are really driving a lot of this thought process. And that's what's happened with Caterpillar. Caterpillar has had some poor earnings. They've had some things where, they've had some losses and whatnot, and their 50 days crossed their 200-day moving average line. And that's an indicator.
That can be a leading indicator, right? Because it's an industry. I mean, that's when people are buying CAT, when they are putting infrastructure in.
Right, exactly.
And we're growing. That's when CAT's on the rise. When CAT's coming down, we start taking a look. It goes back to that small cap index that we were talking about before.
Yeah, and I think I'm not ready to cancel CAT out yet. And I'll tell you why, Seth. The reason I'm not ready to cancel CAT just out entirely, and I think that's why a little bit of the hesitancy in the marketplace exists, is because when we brought $1 trillion back from the repatriation tax benefit, allowing companies to bring money back to the United States, and that $1 trillion, there is a lot of stock buyback, which is helping our market create some substance, as I was talking about earlier. But I really think that ultimately, that's infrastructure dollars that were being held for Europe and Dubai and a lot of the places that China was claiming that a lot of the steel selling was going to happen, which is why they were concerned about buying our bonds at one point. And I think that when you actually break this out, I really think that those assets, though they're going to buy back a lot of stock, that's going to drive a lot of their U.S. equity and value. And I think that's going to drive more of a, construction-based thinking. I don't think we've hit that. I mean, that tax just happened last year. That means, like, if you're an architect, you're building something, you're working on something, like, there's such a delay in the time and the work involved before, boom, the caterpillar's in the ground digging a hole. I mean, right? I mean,
yeah, I 100% agree with you here, Ben. These are movements and fluctuations, and just because one or two of these start to appear doesn't necessarily mean that it's enough to really try to gauge or judge or look into that crystal ball again of what's coming down the pipe in the next year or the next 2 years, because we've seen sectors roll out that are leading indicators and roll right back in.
Yeah, and I think, and I wonder if what's going on is kind of a settling effect, because you have the kind of the coming down of one tax code, one market increase, one event financially that our country has been growing off of, and now you have this kind of new event where we have the buyback of stock and the prep of all this $1 trillion coming into our economy, essentially from the repatriation tax. I wonder if we're like kind of coming out of a lull of one. If you can, I'm doing it with my hands right now. I know you're watching me, but like,
hey,
one's
everybody,
kind of,
this is great visualization that he's got going on. Yeah,
if you can see, we're going to get to Facebook Live one day, but one's dipping, but the other tax code, the other benefit of that $1 trillion is kind of starting to pick up that pace. And I wonder if we're just kind of in a segment of time, a few years segment of time where we don't see cranes rocking our skylines, because I mean they are right now. I mean you go down to Boston, I mean there's cranes everywhere. But I was in England a couple of years ago, and there was cranes literally everywhere. Like if you took a picture, every picture seemed to have a crane in it. And I think, I don't know, I think we haven't really seen the entire benefit of that. And I think China's GDP has been growing at 6-7+%. And when it's not that high, they're in a recession almost. But I think that's because our tariffs are so low. I think they were able to capitalize on significant growth in that. I think that with a tariff increase, I think that's really going to help us as a country, not just for the next, if you're a Trump fan, not for the next just 4 years. This tariff negotiation is going to help us indefinitely until that tariff changes again. And it's something that we need to kind of bring some of that, that growth to America by doing that. And China is going to try to sell us that steel. And I'm a proponent of seeing some growth in this. So I'm not selling out on CAT yet.
Good call. I think that's going to do it for us here. We've been having a lot of fun talking about the Dow. You heard it here first, Dow 30K. I think we should be there, I don't know, in a month or two. That's kind of my guess. It's only 11%. It'll happen. It's going to be there. But so we dove into a little bit of the history. We dove into the reasons around that and some of the components and how it's built, what it could mean, what it might not mean, what their perspective around the Dow is. So hopefully you've had some fun with us here today. And if you have any questions, if you want to give us a call and have the Dow talk, we'd love it. You can get a hold of us at 855-226-8551 and info@yourmoneyontap.com. My name is Seth Krussman.
And I'm Ben Brayshaw.
You've been listening to Money on Tap.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.